Good afternoon and welcome to today's webinar on tax year-end planning, particularly focusing on the accumulation phase. My name's Tom Kimchi. I'm the Head of Advice here at Netwealth, and I'm joined today by Jill Van Gass, a client advisor. Today we're going to be talking about accumulation specifically. Before we look at some of the specifics, I wanted to talk about some general planning points that are always important when investing, but particularly when focusing on accumulation. So one of those is making sure you are invested, thinking about being invested in diversified portfolios rather than holding too much cash. One of those points that's really important is making sure you're appropriately diversified, not holding too much in one particular geographic region or one particular asset class. So that's always useful, but particularly when you're building up wealth before you get to a stage like retirement. Another thing that's really important is using tax allowances when available and exemptions, and that's what we're going to focus on a lot today. So things like pension allowances, ISA allowances, and some other things that are related, like general investment accounts. And the final one that's very, very important when investing is keeping fees as low as they can be, certainly for an equivalent level of service. So first I'm going to pass over to Jill, who's going to talk about pension contributions. What are some of the key areas clients should consider there when approaching the tax year end?
Yeah, absolutely. Thanks, Tom. So I think we always start with the basics, and you alluded to it now, but that's making sure that clients make use of the tax allowances that are available to them. The first of those allowances is the £60,000 annual allowance that you can contribute into your pension fund, and that's available to everyone. And then it's also important to remember that you can carry forward previous year's unused allowances from the prior 3 years, so that you've got scope to increase that £60,000 allowance if you haven't utilised your prior 3 years' contributions. So that can really top up your allowance into your pension fund every year. And then, of course, remembering that pension contributions are very beneficial for higher and additional rate taxpayers, where you're able to claim back that tax relief in your income tax return on those contributions. So definitely making use of pension contributions would be sort of first and foremost the first allowance that you would make use of. And then for clients who may be business owners, own their own businesses, it's also important for them to realize that they can contribute to pensions or make employer contributions into a pension for themselves too. And that, I guess, has the advantage of getting the funds quite neatly out of the business, so that it reduces the corporate tax that's payable on business profits. And these pensions these contributions rather, would go into your pension gross. So just something to consider if you are a business owner, not to forget that pensions are still an important part of your tax planning and your financial planning. And it's quite a nice way to get money into your pension by making use of those employer contributions.
Yeah, a couple of things I'd add on pensions. One, of course, if you're younger, you need to be mindful that you probably can't access your pension until you're 57.
Very true.
Important to be mindful of that. Lots of advantages, as you say, but of course, if you need the money in the short term and you're nowhere near 57, it's probably not the best idea. Also, for those that are particularly high earners, then you might be tapered on your annual allowance. So that's worth checking and potentially considering some financial advice to see if you do fall into that position. And then the final thing I'd say on pensions is just with the recent changes announced at the budget last year, that might have put some people off pensions a little bit because now they form part of your estate for inheritance tax purposes. But that, of course, only affects you if you don't expect to use the pension in your lifetime. So, you could pass away prematurely and that benefit is still lost. It's now inside of your estate. But for most people, they will use their pension. So that shouldn't put them off investing further.
Absolutely. So we still think it's largely beneficial to invest in your pension fund, despite the changes that are coming in April 2027. And I think, what we've seen in the past is that changes happen all the time. So rather than sort of make rash decisions before that change comes in, or even afterwards, the rules are constantly changing. So make the best decision with the information that you've got at hand at the moment. And with that being said, pensions are still unbelievably effective. The growth within the pension is obviously still tax-free. There's no capital gains tax payable. So still a very valuable source for clients. And like you say, depending on the size of your estate, impacts on whether you need to start thinking about inheritance tax planning and what that means for pensions being included in your estate. And that's something that you can always reach out to us if you need more bespoke advice on that.
Excellent. Should we move on to ISAs? And I would say
Yes.
that's probably the next best place to go in terms of tax efficiency. What do clients need to think about when considering their ISA allowance?
100%. So ISAs would be your next sort of low-hanging fruit in terms of allowances made available to us. Every year you get a £20,000 tax allowance or allowance into an ISA that we encourage everyone to make use of as much as they can. Having said that, now as we approach the end of the tax year, if you don't have £20,000 sort of available to invest in your ISA, or you haven't made use of your full ISA allowance and you don't have the funds available, it's always important to remember that you can move funds from a general investment account if you've got one into your ISA. So make sure that you're using that ISA allowance every single year. It makes a lot of sense from a tax perspective. And that's something that Netwealth can do for you automatically as a Netwealth client. So if you're unsure of how we do that, please reach out to us. But you can automatically subscribe to have that £20,000 allowance utilized every year. And then running alongside sort of a normal ISA would be your lifetime ISA, which is something that is slightly different that some clients might want to consider. Particularly if you're younger, they are set up to save for purchasing your own property, or your first property rather. That allowance is £4,000 a year. It does form part of your £20,000 allowance, but the lifetime allowance has the benefit of being topped up by the government by 25%. So something worth considering if you are looking at getting onto the property ladder. If you don't use that lifetime ISA to purchase property, you can then access it for retirement from the age of 60, or if there had to be a reason for ill health. So just another sort of point that you can think about, encourage your older children to think about maybe too if they're not aware of it. ISA is beneficial in general, like a pension, in terms of tax efficiency. There's no income or dividend or capital gains tax within that fund. They're straightforward to set up. There's no need to include them within your tax return. So really easy for clients to get on board and make sure that they're making use of that allowance as much as they can. And then additionally, you can get a junior ISA too, and that would be for children under the age of 18. That allowance is £9,000 a month. So if you've got, not a month, sorry, a year. So if you've got children worth setting up ISAs, junior ISAs for them, you can build up a really significant nest egg for them by the time they reach 18 and set them up really well for life from then. So planning as a family, I think, is another really important sort of tax planning point ahead of tax year end. Make sure that if you're saving for your children in junior ISAs. Again, if you're a married couple, make sure that you're using your spouse's allowances too. So that would be £20,000 each that you can contribute to an ISA. Well worth making use of, I would say.
Definitely. And I think one of the things to bear in mind is the difference between the stocks and shares and the cash ISA.
Yes.
So we at Netwealth, of course, tend to focus on stocks and shares ISAs, although we do have risk level 1, which is very similar to cash overall. But when thinking about whether to use a cash ISA or a stocks and shares ISA, one thing I always speak to clients about is, what is the purpose for this? If it's for the long term, then you're normally getting best use of the tax-free ISA environment by investing in stocks and shares, where you're expecting a higher return than you would from cash. So cash can be great. We always encourage clients to hold cash, but often the ISA wrapper isn't the best use of that. And one thing that's been in the news a little bit recently is the potential for cash ISAs to be either scrapped entirely or to be reduced significantly. If that happens, of course, that does tie your hands a little bit, assuming the stocks and shares ISA allowance was to remain where it is. So that's just something we have to sort of keep an eye on and see where it develops. But generally speaking, we would encourage clients to use the stocks and shares wrapper anyway. So moving beyond ISAs now for a little bit, thinking about what clients can do if they've maybe already used their ISA allowance and already used their pension allowance, where would you say clients should consider from there?
Yeah, that's a very good question. So if you have made use of both your tax allowances, we would still think that investing in a general investment account or a GIA for short is still beneficial. And that's really, if you think about, if you've really made use of your allowances, sometimes clients just then leave the money in their bank account, or, and that speaks to your point there on stocks and shares ISAs. And we'll get in a little bit later about investing in cash versus being invested in the markets and the difference that can make. but generally an encouragement to make use of general investment accounts for anything over and above those allowances, allow them to build up over time through compound interest and market returns. And then, of course, you can make use of your CGT and dividend allowances within those general investment accounts. So although those allowances are smaller than they were previously, you still get £3,000 that you can use as your capital gains tax allowance. And it makes sense to sort of make sure that you're using that every year and sort of increasing the base cost of your investment so that you're reducing your cumulative capital gains when you do eventually need to withdraw those funds. So yeah, those are general investment accounts still, although you don't have the tax benefit necessarily of ISAs and pension funds, still beneficial and still worthwhile considering.
Yeah, exactly. And going back to your point about spreading assets potentially among family members, again, if you have a spouse, say, that hasn't used their CGT or capital gains tax allowance, or they haven't used their dividend allowance, it's a good thing to use if you wouldn't otherwise do so, and if you consider your finances on a joint basis. And I think related to that point, there's also pension contributions that you can do in a similar way. Often clients ask, can I fund my wife's, say, pension contribution if she's working, but might not necessarily have the excess income in her own name? A husband in that example, they certainly could fund up to the maximum she could contribute, say. So that's worth doing. And that also applies to children who often, particularly when they're early in their career, might not have enough cash. So although strictly speaking, you're not building your own wealth in that environment, if you did have excess income, it is a sensible way to invest. And the good thing there, of course, if you're investing in a pension on behalf of your child and you're not quite sure about giving them a large sum as an outright gift, that ties the money up in their name until they get to retirement age. So that can be a useful benefit as well. But again, you mentioned the junior ISAs earlier, and a really good thing to do for children that are under 18, but even once children are older, they might not be able to fund their £20,000 allowance, but they may well be able to do so with a gift from their parent. So also worth considering if there is spare cash and if estate planning is a sort of secondary goal to your wealth accumulation.
Absolutely.
Beyond investing, many clients, of course, will have mortgages or other forms of debt. What would you say is a sensible thing to consider there if you have, say, competing objectives of maybe contributing to your pension or repaying a mortgage?
I think competing objectives is definitely the way to put it. Debt can be stressful and can often be sort of emotional too. Mortgages, credit card debt, whatever the case may be. And I think it's important to consider when you repay that debt. And the first thing we would encourage you to look at your interest rates, and effectively, if when you're paying off debt, you're earning a tax-free return on that debt that you've paid off. So it's worthwhile considering, especially if you are locked into debt that is yielding a higher interest rate. Try and squash that as soon as you can, we would say. And if you don't repay your debt, then it can be quite an adventurous strategy, because if you think about it, you're effectively borrowing cash to invest. And that's really, I guess, using leverage, which can work in your favor, but it also can be quite a risky strategy. So something that you can definitely look at, look at the interest rates, look at what you can earn in the markets relative to the interest rate that you're repaying on your debt. When it comes to mortgages, sometimes there's a prepayment penalty, so those are all things to consider. But generally, we would encourage you to pay down especially higher interest rate debt.
Yeah, I think so. With interest rates much higher than they once were, it's
yes.
an easy decision maybe to choose to repay the mortgage compared to if your mortgage rate was, say, 1%, like it might have been a few years ago. But I just wanted to go back to another point actually as well on investing outside of the ISA and outside of the pension, because I think looking at some of the recent changes that have happened, and as we approach the new tax year, again, if you've used your ISA allowance, you've used your pension, you might be thinking, okay, I want to invest, but tax rates have gone up as well. CGT rates are now a little bit higher than they once were. Does that mean I shouldn't? But I think actually, and you did touch on this already, and I think you might well expand on it later on in this session, but actually, even after tax, even with the tax rates higher than they once were, you're still likely to get a much better return from that than you would by investing in cash. Because of course, if you keep your money as cash, then you still pay income tax on that interest. So even with those CGT rates a little bit higher, even with the dividend allowance a little bit smaller than it once was, for most people, it still will be better, certainly over the long term, to get invested and to keep it there.
Absolutely. Maybe now's a good time to talk about that cash versus investing, now that you've sort of raised it. And there is a really nice slide that we can show you here, which illustrates why investing is important relative to just by sitting in cash. And by just keeping your money in cash, you're not going to beat inflation over the long term, which really means that you're eroding your purchasing power, which I don't think anyone wants to do, or certainly not willingly. So the graph that you see here shows really nicely the difference between being invested in, we've used a Netwealth risk level 4 portfolio versus just staying in cash. And it starts on the timeline of 2007. And you can see the massive difference there between being invested and not being invested. So I think it's definitely worth something to consider, something to make sure that you're on top of, making sure that you're investing any excess cash, again, according to your risk profile, your time horizons. That of course is important. We encourage clients to keep cash for short-term expenses or outgoings. That's prudent to do. But anything, over and above that, you could look at then investing, as this graph illustrates nicely for you, the difference that it can make, especially over the longer term. And we expect interest rates to decrease. So, it's even more compelling to try and get a higher rate of return on your hard-earned money.
Yeah, exactly. It's very likely, of course, interest rates come down over the course of this year. Exactly how many interest rate cuts there might be, it's hard to say specifically. That'll depend on what happens with inflation largely. But nonetheless, it is very likely that they come down, and that will only make it more likely that you want to invest. Because right now, actually, we're in a fairly unique position where interest rates are higher than inflation, but that certainly won't last for the long term. And often when interest rates are cut, that's when equity markets do quite well. If you look at sort of historic track record. So what would be quite dangerous for clients is to wait for interest rates to come down and then switch into equity markets or investment portfolios, because by then they might have missed some of the strong returns. So, you don't quite know exactly when interest rates will go up or down, but you do know that relationship is likely to occur. On a slightly different note, one other investment vehicle I think clients might want to consider, or might want to think about at least, particularly if they've used those ISA allowances and those pension allowances that we've talked about, is investment bonds, or offshore bonds to be specific. So this is quite a niche area, and it's an area where you would be heavily encouraged to take advice, and in many cases you're actually obligated to take advice to consider an offshore bond. And it certainly won't be right for most people, and certainly not those that haven't used their pension or ISA allowance. But if you did have excess funds that you didn't need in the short term, and you were a high rate taxpayer and could tie this up for a long time, or indeed if you were likely to move to a low tax jurisdiction later in life, then that might be something to consider as well. With offshore bonds, you don't pay any tax whilst the investment's growing, but you do pay income tax on all of the gains at the end. So if actually you're going to stay in the UK and potentially be a high rate taxpayer in the UK, it will actually end up costing you more because capital gains tax rates are lower. So it's certainly not a no-brainer, and not something you should rush into without considering very carefully. But again, for those that are paying maybe additional rate tax now and might be only a higher rate taxpayer later in life, or for those that might be a base rate taxpayer later in life, then it is worth considering. So that's it, I think, for our points on accumulation phase as we approach the end of the tax year. If you have any questions at all, please get in touch. Otherwise, thank you very much for joining.
Thank you.